What is up, everybody? Welcome to the Monday Market Update. My name is Sean Grapevine, back from last year, first Monday Market Update of 2023, and I am ready. I'm ready for good news every single week from the man who joins me here. The only thing he asked for Christmas was Bips, and he got them. He likes his Philly with extra cheddar. He does best efforts with no effort. His GPA at the University of Texas was higher than today's 10-year T-note. He's the Titan of the 10-year. He's the Baron of Bips. He's the Lord of the Locks. It's Austin Koenig. Welcome back, Austin.
Thanks, Sean. I appreciate the always great intro. I appreciate that. It's definitely something missing when Rob's on here. I feel like we just don't know how to pump each other up at all.
Yeah, well, Rob may lack my panache, but he does. He replaces that with actually knowing what he's talking about. So, it's a give and take. It's a give and take relationship.
Well,
Thanks for joining.
Right?
What's that?
So I said, speaking of knowing what we're talking about, what about these market predictions that we've been waiting for?
Okay, I'm so excited, guys. We've got people from all over the organization who put in their predictions for the end of 2022 wrap up, and we are about to announce the winners for the 5 categories that we had. We had the what's the 10-year going to be at? What's the Dow Jones going to be at? What's the Freddie Mac average rate going to be at? We had what's the conforming loan amount, and we had the price of Bitcoin. So I will I've just lost them. Here they are. And go ahead and announce those with as much excitement as I can. Freddie Mac, the average rate at the end of 2022, and this is good news for all of us, was 6.42. That's much lower than it was 2 months prior to that. And the man who won that, I feel like, has inside information because he was the. Oh no! I got this wrong. This guy. I'm doing such a bad job of this. I didn't prepare at all. The winner of the Freddie Mac survey, 6.42%, was the final number. The estimate by Freddie Piacello was 6.39%. He was within 0.03%. So that makes me feel like he has inside information. But we know the next guy has inside information. The Dow Jones closes at 33,147, and Rob Piccolo has it at 33,250. I think he went back and just changed his answer after he saw the numbers come out. You know what I mean? What are the chances?
No way he didn't.
Yeah, Rob Piccolo helps host this, and he also gets the answer right. So I'll tell you guys what the prize is here in a second once we get through all of these. The U.S. 10-year closed at 3.871. It's already way better than that. Like I said, we're off to a good start. Austin decided to give us only good news this year when it comes to the market. So we're just going to see that number go down every week. But it ended on December 30th at 3.871. And guessing 3.812 was Rebecca Richardson. Congratulations, Rebecca. Big winner. I love to see it. Bitcoin price at noon on December 30th, 16,487 and 10 cents. Man, glory days are just over. What's that down? 75%? Estimating 16,599, which is only off by $112, was Nate Joma. Congrats, Nate.
There we go, Nate.
Yeah, there we go. And from the Atlanta branch, getting the first one right, because we knew about this back in early December. The conforming loan limit, $726,200. The closest person, again, from the Atlanta branch, the best branch, Thomas Meister, $725,200, only off by $1,000. Everybody else was pessimistic. They didn't have any hope. They were scared it was going to be low. But we know in the Atlanta branch, only good news for this year. And Thomas was within only 1,000. So the prize is a Titan of the 10-year UMortgage T-shirt. We will be sending those out in the next week or so to our various winners. Again, it's Freddie Piacello, Rob Piccolo, Rebecca Richardson, Nate Joma, and Thomas Meister. Congrats, everyone.
Yeah, that's awesome. Everyone, thank you for participating in the first place. I think it's great to see, and really everyone did it. Like it was cool that someone was very, very close to each one. I mean, I think there's a lot of skill involved, maybe a little luck, but
Mm,
yeah, this is awesome. And I think we should do this again next year. This is a great
absolutely,
exercise.
absolutely.
I think
We
it
could do
kind of
it.
just gets people at least cheering for something in the market, you know.
Yeah, absolutely, absolutely. Except for all those people who ended up, we're estimating 10-year in the 4% range. You guys aren't invited back. Okay, we only want positivity here. So speaking of positivity, Austin, what happened last week? What's happening this week? Give us the lowdown on mortgage rates. The bond market in general, employment and inflation.
Yeah, so the constant themes, right? Employment, inflation, Fed, what's happening in the mortgage market. So the first week of the year, we actually did have a pretty eventful week, especially at the end, where we had the jobs report for December come out. So ADP numbers, so just so everyone's aware, there's kind of like two different indicators of the jobs report. When I mean jobs report, a lot of people just reference the one that comes from the Bureau of Labor Statistics on Friday, the first Friday of every month essentially, and that number came in better than expectations. And one thing that has something to kind of look further into with that report is they also come out with average hourly earnings as well as like unemployment rate and like participation rate
Interesting.
in employment.
What are the
So
average hourly earnings these days?
they're like higher than they would be on a typical year, like in terms of like how much they typically increase. So in theory, right, your hourly earnings should pace with inflation to kind of keep prices normal. Now we actually saw, hourly earnings kind of like kind of have a dimmer outlook in terms of like they were slower to grow. They actually had a worse month generally than expected, and that's
Hmm,
actually what I would say good news for the Fed.
good,
The
right?
reason
Okay.
why that would be good news is because, yeah, good news. Everyone's making less money. Good news. That's, obviously that's not something that, as a consumer, you'd be like, I don't want to make less money. I want to make more money so I could go buy things more. I want that new grill. I want that new, piece of a clothing item, right? Well, the
Mm,
thing is that the Fed knows that that kind of demand uh, drives inflation, essentially, right? So when it comes down to the way the Fed will look at inflation, they want hourly earnings to also kind of pace down to the target level of like around 2% or less. And so that's good news that hourly earnings are starting to trail off. That means kind of labor market's less competitive in terms of price gouging for salaries and
mhm.
everything
All right,
like
so there's a
that.
little less, yeah, a little less competition. Like still enough competition that there's not enough jobs out there. Still enough
Mhm.
competition that like unemployment's like going up, but like the first signs of maybe a little bit of cracking in the labor market that like the less competition for each job opening.
Correct. It's going from red scalding hot to like hot.
Huh.
It's still a good job market, and jobless claims have not come in strong. Like in terms of like high jobless claims are going crazy. We've seen jobless claims kind of always fall below expectations. Even last week. We'll see what happens this week. But another thing that we need to look at too is the ADP one, and the ADP kind of mimicked where we were in terms of. Um, I think generally ADP data looks fairly accurate too, and I would say no one's trading off that one as much. But the one on Friday was, I think, the big one that everyone kind of traded off of, and the hourly earnings. I think that's what kind of drove rates down, especially as we kind of got near the end of close. It was a good day for the bond market. Today we're kind of having a flat line. At least that's what it was to kind of start the morning. Maybe a little bit worse, but not much. We're also seeing this week inflation data. That's going to be a big one. That's on Thursday.
I'm so
Um,
excited.
and
It's my favorite. It's my favorite day of the year. I mean, of the month. Every month.
every, and I think everyone looks forward to it. And generally, what we should be seeing here is we should be seeing inflation continue to slow. We talked about this a lot last year as if we have inflation that kind of stays or like just prices just stay where they are right now, we're going to see inflation get to near the target very soon. If we just have like a 0.1 or 0.2% month, price increase, every month, we're going to get to the target rate, sometime later this year, like in the second half. And that is the goal, right? And that's kind of where we have to see where the Fed reacts, because we're not going to have another Fed meeting, and I think until sometime in February. I don't know the date off the top of my head, but we need to know how the Fed's going to interpret this data, because if we see slowing inflation, or maybe even like price decreases, like a negative 0.1% or something like that, that would, I think, throw the bond market for a little bit of a curveball there, because that's something that people in the back of their mind are kind of concerned about. Like, well, what if inflation cools off too fast and we have some sort of deflationary environment? It's kind of weird talking about that when you still have a headline of 6.6.
Sure.
But
Yeah.
in general, though, it's something to pay attention to.
Yeah, crazy. All right, so remind me, what were we at the end of like what were November's numbers that were announced in December?
November's numbers. So we were at 7.1.
7.1. Okay, sweet.
This
So
headline.
we're really hoping to see, like, essentially what you're saying is we're hoping to see, the market's probably expecting to see 6.8, 6.9, and like would love it if it's lower than that. That's generally how it's been. Like, we want to see 0.3 on the year over year as sort of like that's like the expected.
Yeah. So I think so. Right now, the median estimate is 6.6%. So.
Oh wow. Okay.
If we get above that, I think it takes a little bit deeper look into the data, to be perfectly honest with you, to kind of how you interpret it. But generally, though, I would say hitting 6.6 or even being below that, I think it's a pretty good.
Interesting.
It's
So now we're starting to see these bigger expectations every month. Does that mean that there's less room for big swings in the bond market? Like, November was so fun because they were like, we think maybe it'll go down a little bit, and it went down like, whoa, 4 whole tenths or something, like, really small, and like the market reacted really well. Now we're looking at 5 tenths, 6 tenths of a reduction in CPI. I mean, like, the chances of it going above that, it's like we're not going to have any of those mega take us by surprise days. Sort of the soft bigotry of low expectations. I think it's a George W. Bush quote.
I think you're on the right track here, Sean. I think what we have to deal with here is a market that prices things in, and what happens on these days data gets released is figuring out what actually was priced in, and the conviction behind that data, right? Like, where's the conviction going to move the market? I think generally we can go lower in terms of rates than here, but there's no room to really go down to the bottom, like 3% 10 years, something like that.
Sure.
Something crazy with any sort of CPI data that comes out in the next month or two. That really is driven by, I think, we're really seeing start to see weakness in the general economy. That means the Fed needs to lower rates. I think, if you listen to what the Fed's saying, they are saying nothing along those lines right now. They're saying higher for longer. We're going to keep on raising. We're not done yet. Where we end up, it's kind of, we all think it's going to be about 5%, but who knows? There's kind of all these different interpretations. And is the Fed going to be behind the 8 ball once again? Probably, but the market just has to figure that out itself. That's the beauty of it, right? The Fed doesn't make the market. They are just a big, kind of, I would say, authority, but the market itself can price out wants to price every single day. And that data, every trader, every investor, they are looking at data real time, or as real time as possible, rather than lagging things, or just looking at the GDP number. Everything that goes into here kind of affects GDP. So they need to know, okay, how's the economy faring, and what should we be prepared for? Q1, Q2, but in real time, not a quarter later or a month later after that quarter is kind of announced. So, hey, the economy grew. So that's the way we have to look at it, is as real time as possible, the way the market interprets it.
Yeah. And as far as applicability to loan officers, guys, like this, I think a lot of people here maybe got started in 2019 or later, and maybe 2020, or like really started doing a lot of business then, or choose not to remember anything before 2020, or are unable to remember anything before 2020. But 4% and 5% rates like the American public is, I mean, we're seeing that they're okay with sixes. We're seeing like, our applications in our branch are picking up. The Atlanta market is picking up. Like there was some shock from going from 2.5 to 8. You know, and prices are obviously a lot higher, which makes that shock a lot worse. But now we've seen, people get used to the rates. We've seen, rates come down a little bit into the mid sixes and stuff like that. But like, we sold in 2019. That was most, seasoned loan officers' best year, and we didn't have any refinances really because rates were going up. But the job market was strong, and the property market was strong, and everybody had equity, and uh, uh, interest rates are in the high fours, low fives, but everybody's DTI had gone down a little bit over the past 4 or 5 years. Everybody had a little more savings. They had a little bit less debt, which is similar to what we saw as a result of the stimulus and the increase in wages that we're seeing. Yeah, I would liken this upcoming year to 2019, which if that wasn't your best year to date before 2020 and 2021, I'd be really surprised. So yeah, as crazy as it sounds to hear, 5%, 5.25%, 5.5%, it's man, people have been doing that for a long time. I think a lot of people said that when we hit 7 or 8% this year, and they were like, well, I sold 18%. It's yeah, well, grandpa, that was 1981. So that's not really applicable. We were selling 5% 3 years ago and it was fine. Nobody cared. So just wanted to give a little perspective and some actionable insight there. And so build up those referral bases, build up those relationships, because it's about to get busy again. You want to have those relationships in place for when your market gets busy and when people really come back on them. That's my little soapbox.
100%, Sean. I think that's great. That's a great message right there. And yeah, obviously seasonality hurts in December. So December is going to be a very slow month. We're going to come upon spring, here before we know it. And I think people, like you said, applications are starting to take up. People are going to start looking around. They know, hey, rates are not as high as they used to be in the peak of 2022. Let's start looking around. We hear about this weakness in the housing market. I think people are going to start looking.
It's going to be attractive. People love a deal. You know what I mean?
Exactly right. Exactly right. And if the affordability works out, it works out. And at the end of the day, I think business is going to pick up here for a lot of people and a lot of markets.
Amazing. All right. Well, thank you for joining us, everybody. Thank you for joining us, Mr. Austin Koenig. We will see you, everybody, next week. Austin said his New Year's resolution was for all of you to get him to lock some more loans. So please make his New Year's resolution come true. Send him some deals to lock. And we will catch you next Monday to digest the CPI information. Thanks, everyone.
Of course. Thanks, John. Thanks, everyone.